Hello and welcome to Tax Matters. I am Chamaka Ohaochi. The topic or issue, if you like, on the lips of everyone now is the Finance Act 2019. As you already know, the law was assented to by President Muhammadu Buhari on Monday, the 13th of January 2020. The Finance Act has far-ranging provisions covering virtually all the Nigerian federal tax legislations. The Finance Act has 5 major objectives, as espoused here by the Honorable Federal Minister of Finance.
The Finance Bill has 5 strategic objectives. The first is promoting fiscal equity by mitigating instances of regressive taxation, such as tax reforms for the insurance industry, which has been explained earlier on. Second is reforming domestic tax laws to align with global best practice. And in this area, the example I will give is taxation of digital business as well as e-commerce. Thirdly, introducing tax incentives for investments in infrastructure as well as in capital markets. And the targets for us is to provide incentives for real estate investment opportunities and security lending in the capital market. The fourth objective is supporting micro, small, and medium-sized businesses in line with the ease of doing business reforms. And in this area, what we did is lower company income tax from 30% to 20%. We believe by doing so that small businesses will be encouraged to be formal and to actually grow. The fifth objective is, of course, raising revenues for government to finance its budget. And the example I'll give here is that we have increased the VAT rate from 5% to 7.5%. We've also introduced excise duty on some imported excisable goods. And the essence for us is to bring parity with goods that are similarly manufactured in Nigeria, to remove the disadvantage that the local industries are currently facing.
There you are, to shed more light on the provisions of the Finance Act, to enlighten our dear viewers on the impact or how the Finance Act affects them. Joining us on today's episode of Tax Matters is Mr. Taiwo Oyedele. Mr. Taiwo Oyedele is the head of Tax and Corporate Advisory Services at PwC, Nigeria. Mr. Taiwo Oyedele, welcome to Tax Matters.
Thank you, Amaka, and thank you, Tax Matters, for having me.
As you heard in the introduction, our task today is to dissect the Finance Act, to break it down for the layman. Let's begin this way, sir. Are there any material or significant differences between what was sent to the National Assembly, which was discussed at both hearings at both houses, with what was sent to Mr. President for assent?
Thank you. Let me start by saying we Nigerians, we are aware of the version that Mr. President presented to the National Assembly because the National Assembly published it in the newspapers. So officially, we know what the content was at the time. I attended the public hearing at the Senate as well as the House of Representatives. So they got the input from everyone. After the public hearing, they went into detailed analysis and amendments. And indeed, they made changes to the finance bill. So we do know, therefore, that changes were made. Mr. President signed the bill and told us on his Twitter handle that he has signed. For the sake of our analysis, the version that is everywhere that people have seen as signed by the President has significant changes to some of the provisions. One of it is that we now have tax exemption for 8 years for any company involved in agricultural production. So we didn't have that before in the original version. Number 2, we have now specific provisions for companies for their bank accounts to have tax identification number. If they already operate the account, they have 90 days within which to regularize and make sure that they have a TIN for their account. In the original version of the bill, this was only available for individuals, not companies. It was not a requirement for companies, even though in practice, banks are already doing it. The other provision is minimum tax. The basis for calculating minimum tax has been amended in the final version that went to Mr. President, such that the 0.5% of turnover is not just your turnover, it's your gross turnover. These are some of the changes that have been introduced between when it was presented to the National Assembly and signed by Mr. President. This is the first time in 20 years that we're having, in fact, I would say, maybe the first time in a generation, because what we used to have up until 1999 were the decrees by the military. And they will touch on a couple of areas of the tax law, but nothing as comprehensive as what we have now. This Finance Act effectively has amended 7 different tax laws. It has introduced over 100 different changes, so it's significant. So the highlights for me would be, I'll say, I'm particularly excited about the provisions for SMEs. So because in Nigeria, we need development like tomorrow. Also, we have high level of unemployment. We have a lot of small businesses. According to the Bureau of Statistics, around 40 million MSMEs, but a lot of them are struggling. So I like the fact that there's a deliberate design in the Finance Act to enable these small businesses to reduce their tax burden and make them become successful. If these 40 million thereabouts MSMEs become successful, let's imagine that they just hire 1 additional employee, each of them. That's 40 million people out of unemployment. So that for me would be the highlight. All
right. Although I was actually coming to taking it sector by sector, okay, which you've already touched on the SMEs, that is the small business owners. Apart from what you mentioned, are there still other benefits, other things that they could really benefit from this Finance Act? Yes, indeed. In addition to what I've mentioned, so small businesses, if your turnover in a year is less than 25 million, so arithmetically that comes to about 70,000 sales per day. You no longer need to register for VAT. You don't have to charge VAT on your goods and services. What that means is, as a small business owner, your goods and services become more affordable. More people will patronize you, and then you can grow quicker. Number 2 is, in terms of a corporate income tax, if your turnover is less than 25 million, your CIT rate is now 0% from 30% before. If you are a little bit bigger than that, we call you, based on the Finance Act, medium-sized company. That is, your turnover is more than 25 million, but it doesn't exceed 100 million. Your tax rate is now 20% instead of the 30% before. This is also an advantage for them. In addition to that, SMEs, in most cases, are expected to patronize, some of them, microfinance banks. So in this Finance Act, the services of microfinance bank, mortgage institution, and people's banks are now exempt from VAT. So you don't need to pay VAT on those services that they render to you. And we also expect that small businesses make small transfers electronically, 1,000 here, 3,000 there. So this Finance Act also has now raised the threshold for paying 50 Naira stamp duties from 1,000 to 10,000. Until when your single transaction is up to 10,000, you don't have to pay. So these are some of the benefits for MSMEs in the Finance Act. You mentioned some points that I'll still come back to later on. No problem. So now let's look at the insurance company. What is in the Finance Act for them? Yeah, for a very long time, I've struggled to understand why Nigeria, almost like deliberately, are punishing insurance companies and insurance players and the insurance sector. In most developed countries, you find insurance companies are even bigger than banks. In fact, many of them own banks. But in Nigeria, the tax law is so unfavorable to them, it's almost impossible to thrive. Some of the discriminations include they have a special minimum tax that can be as high as 20% of their gross income.
They are unable to carry forward their losses indefinitely like any other person will be able to do. And you also have the inability to deduct certain expenses. Even though these are legitimate expenses, the law just say you cannot deduct more than this amount. So those discriminations have now been removed. So which means insurance companies now are treated equally like other taxpayers. And that speaks to one of the objectives of the Finance Act, which is promoting fiscal equity. So yeah, I think insurance sector players should be excited.
Sure, they should.
Yes.
Now, what about startups, those who are just starting out? What is in this Finance Act for them?
Yeah, the good thing about the Finance Act is there's something for everybody.
Yes,
So for small business, not small businesses, startups, those are just starting their businesses. One is what we call commencement rule. Now, interestingly, this commencement rule, we inherited it from the British when we were under colonial era, such that when you start a business, within the first 3 years, we apply what we call commencement rules. And it plays out such that you pay tax twice on at least the profit of 1 year. Now, it doesn't make a lot of sense that somebody is just starting their business. In fact, they're struggling to find salaries to pay their staff, where to pay rent, to run generator, and you're asking them to pay tax twice. So they have now removed that, which means this double tax will no longer apply. And I think in addition to that also, a lot of startups will start small. So which means you won't have to register for VAT if you expect your turnover in the first year of business to be under 25 million. You won't have to pay CIT until you exceed 25 million turnover. So all of these, I think, would in a way encourage people to start new businesses. There was a report I read saying that Nigeria is actually #1 in the world for entrepreneurial activities. So we have more entrepreneurs in Nigeria than any other country in the world. But unfortunately, many of these people don't survive beyond 2 or 3 years. Some of it is due to taxes. So if we can now start addressing those problems, particularly also address multiple taxation, we have more businesses start in Nigeria, they will thrive, they will grow, employ more people, and then we can have economic prosperity.
All right. So now coming back to the points you mentioned earlier when you were talking about the small businesses. Now, I'm worried. Some people are worried. So I don't know, well, maybe I should ask, are you not worried that some of these business owners whose turnover are below 25 million naira would take negative advantage of this 0% CIT rate, whereby if they are, let's say, I'm about to cross that threshold, I could just go and register a new company, and that means I'm not paying the CIT, or I'm not paying the CIT rate forever, resulting in loss of revenue for the government. What's your take on this?
Yeah. That risk is there. Human beings are economic animals, and they are largely selfish, which means they think about themselves and they look for loopholes and take advantage of it. So there are 2 points. One is you really have to be small to keep splitting your business every time, right? If you're really prosperous and you're doing well, it's almost impossible to cope, because at some point you're going to have 30 companies. Okay, so that's one thing. The second thing is Mr. President has promised, and we do agree and believe, that the finance bill will be an annual exercise. So what we expect is the FRS is going to be collecting data now. If they see that there's an abuse, in the next finance bill, we just put an amendment there that says, for the purpose of applying this exemption, we would apply it based on control. So which means if the beneficial owner of the company or companies, if you aggregate all their turnover, if it exceeds 25 million, you have to pay tax. So in which case, you really have to go and give your company to another person and dash them just because you don't want to pay tax. So I'm not worried, because I think it's something that can easily be plugged if we see an abuse of that loophole.
Okay, interesting to know. So the FRS should really be on the lookout.
Absolutely, they have to.
All right. Now, somebody asked if that provisions exempting business with turnover below 25 million naira, as in from CIT, means exemption from paying all taxes. No. Is this so?
No, it's not so. I know people, sometimes they hear what they wish had been written. not what was written in the law. The law is very clear. It's an exemption from corporate income tax. In other words, all other taxes that you need to pay before, you still have to continue to pay, even VAT. So the exemption from VAT is that as a small business owner, you don't need to register for VAT and charge VAT. So for example, let's say what you do is you sell, bags, handbags or whatever it is. If your turnover in a year is less than 25, you don't charge VAT. But if you are buying anything like mobile phone for your business airtime, you have to still pay VAT. Yes. So which means small businesses are not exempted from VAT in that sense. If you need to pay excise duties on anything, transfer of money above the threshold, you will pay. There's also still, if you import anything and there's import duty, you would pay. There are levies at the local government level. If you have employees, you have to pay personal income tax. So in other words, CIT exemption means CIT exemption. It does not mean exemption from all taxes.
Okay, yeah. Fine. Now, let's look at excess dividend tax, which now only applies to untaxed distributions and other profits that are exempted from tax and franked investment income. So how does this affect, or what effect does it have on holding companies?
Yeah. I'll have to say that the excess dividend tax amendment for me is actually the number one excitement. Maybe that should have been my highlight actually. I have been on the excess dividend tax provision for more than 12 years in my role as consultant advising investors, both domestic and multinationals. And I've seen, sadly, many instances where multinationals were thinking about putting headquarters, holding company in Nigeria for their operation in Africa. And once you tell them about the excess dividend tax, everybody runs away. So we were losing opportunities to build headquarters in Nigeria for companies. So what this law has now done is to say it doesn't make sense to punish you because you are investing your profits, because you invested in what government says is tax exempt. Government shouldn't give you exemption with one hand and take it back with the other hand. So essentially what this one is saying is, you would only have to pay tax, corporate income tax, when you distribute dividend from profit on which you haven't paid tax before, and that profit was not exempted by law, right? So which means if you've paid tax before, it's frank investment income, it's profit from other sources that are exempt, you don't have to pay excess dividend tax. So it means that now it's attractive for anyone. It could be a domestic company owned by Nigerians or multinationals. When they're looking for where to put their holding companies, they should come to Nigeria. We need all the investment we can get. So it's good. It's good for holding companies.
Sure we do. We need all the investment. All right. Now, let's look at the provision in the Finance Act that has to do with the minimum tax of 0.5%. Could you please throw more light on this? Yeah,
so before what we used to have is, people set up their businesses, and even when they are not lying, legitimately, people want to make profit, but they don't always make profit because, the business environment can be volatile. So you make losses, which means business was bad. Unfortunately, in our tax law, government says, well, we are sorry that you made losses, but you still have to pay government some taxes. And they were calculating these minimum tax based on your turnover, based on your capital, based on your assets, based on your gross profit. So a lot of us said, that's not right because you are forcing a company that is struggling already to still pay tax out of its capital. That's the fastest way to kill a company. So even though the amendment now in the Finance Act is not perfect, but it's miles away from where we used to be, it now says your minimum tax is only 0.5% of your gross turnover, which means your gross turnover is defined to be your gross economic benefit received by a company, including dividend, interest, royalty, and rent, but franked investment income is excluded. So essentially, it's government saying, well, we just want to be sure that government is not bankrupt and not out of pocket, just in case everybody start making losses. Let's still make some money from taxpayers. I do hope that in the nearest future, in the next 1 or 2 years, we get to a point where we actually also further amend this minimum tax such that people only pay minimum tax based on their accounting profits and not from their capital.
Okay, sorry. When you mentioned, I asked to franked investment income. What do you mean by that?
Yes. So based on the tax law, there are certain income that you receive, and government believes that those income have suffered too many taxes. For example, if you buy shares of a company, that means you are part owner of that business. So the company will make profit and pay company income tax 30%, education tax 2%. Whatever profit is left, that's what they use to give you dividend. And when they are paying you the dividend, they deduct withholding tax 10%. So the law says this your profit has suffered too many taxes. When that dividend gets into your hand, it's called franked investment income. The law says it should not be subject to any further tax. Before, what we used to have is if that investor were to be a company that invested in another company, after all those taxes have been collected at the operating company level, they get to the investing company level and there's another 30% that is hit on that money. You may then end up with paying taxes of well over 60% ultimately, which is not very attractive to investors. So that's the concept of the franked investment income.
Do you provide goods and services? Then you must answer these important questions. Are you registered for VAT? Do you charge VAT on the goods and services you provide? Do you keep records of all your transactions? Do you file VAT returns? Do you remit VAT collected to government coffers? If your answer to any of these questions is no, then you are breaking the law. The law demands total compliance. Therefore, you must register for VAT. You must charge VAT on goods and services. You must file VAT returns. And you must remit all VAT collected on behalf of government within 21 days to the bank nearest to you. To do otherwise is a crime punishable everywhere in the world. VAT is prescribed by the law. Do the right thing. Collect and pay VAT. This message is from the FIRS. It pays to pay your tax.
Welcome back. We are still looking at the Finance Act 2019 and what it pertains to different sectors of the Nigerian economy. And our guest is Mr. Taiwo Oyedele. Easily the most popular provisions in the Finance Act is the VAT, Value Added Tax, which has been increased from 5% to 7.5%. So what does this translate into for the Nigerian or for the average Nigerian?
Yeah, so I know you're right. The increase in VAT rate from 5 to 7.5% by far was the most talked about subject, because I think a lot of people just were lazy. They just picked that and they ran with it. Government also did not put out enough information about the rest of the amendments in the Finance Act. But the reality is that, nobody is excited to pay more taxes, so I do understand the sentiment. But the reality is that this 7.5% means different things to different people. To government, hopefully it means that they make more money. To small business owners who fall within the threshold of 25 million, it means that their products will not be affected. To the ordinary man on the street, for example, the price of milk will remain the same. That's because milk used to be a basic food item exempt from VAT. It's also still exempted under the expanded list of exempt items. Bread, the price of bread should be lower now, because before, bread was not defined as a basic item. There was supposed to be VAT. Now, it's defined as exempt from VAT, which means it will not attract the 7.5% VAT. Gari should not attract VAT. A lot of the things that the ordinary person would consume are now exempt from VAT. In addition to that, tuition for education, nursery, secondary, tertiary, fully exempt. Medical treatment, medical supplies, fully exempt. So essentially, the way it has been designed is that the burden of the 7.5% VAT should largely fall on the middle class and the upper class. So the people who have the ability to pay a little bit more. Yes.
Are you having fun? Are you being educated? Time or time? It's time to go. This expose on the Finance Act 2019 will continue next episode, next week on Tax Matters. And Mr. Taiwo Oyedele will still be our guide. Make it a date with us. Thank you for watching.